Welcome back to Get Unpacked. You ever see a headline about a billionaire's fortune growing by, billions in a single year, and then wonder how they can legally pay a lower tax rate than most of us? Well, today we're pulling back the curtain on the perfectly legal and honestly kind of mind-blowing strategies the ultra-wealthy use to shrink their tax bills down to almost nothing. Now, this isn't about anything illegal or shady. This is about mastering a very, very complex game. So let's unpack the playbook. Okay, let's do a little thought experiment. Imagine you have $1 billion, but it's not cash. It's all tied up in the stock of the company you founded. You want to actually use that money, buy the yacht, the private jet, whatever. But the second you sell that stock to get cash, boom, you're hit with a tax bill that could be hundreds of millions of dollars. So how do you spend your fortune without actually selling it? That is the billion-dollar question, literally, and it's the puzzle we're going to solve today. So here's how we're going to break it all down. First, we'll look at the core problem, this whole issue with paper profits. Then, we'll dive into 3 huge strategies: the legendary buy, borrow, die method, then the trust fortress for dodging estate taxes, and a really specific business loophole that helps out some of Wall Street's heaviest hitters. And finally, we'll ask the big question: why does this system even work like this? Right, so first things first, let's get one thing straight. When we talk about a billionaire's wealth, we're not talking about a bank account with billions of dollars in it. For guys like Elon Musk or Jeff Bezos, nearly all of their fortune is what you'd call paper profits. It's the value of their shares in companies like Tesla or Amazon. And this creates a really interesting problem for them. They are unbelievably rich, but to actually spend that money, they have to sell their stock, and selling triggers a massive tax event. And that tax event, it's called the capital gains tax. In simple terms, it's a tax on the profit you make when you sell something that's gone up in value. So if you bought a stock for $1 and you sell it for $100, you're paying tax on that $99 of profit. For the highest earners in the US, that federal tax rate is 20%. And that's before you even start talking about state taxes. Just to put that into perspective for you, if a tech founder's stock basically started at zero and they decide to sell just $1 billion worth of it, they could be looking at a federal tax bill of over $200 million. I mean, wow, that is a pretty powerful reason to find a way to get to your money without selling a single share. And that search leads us directly to the most famous strategy of them all. It's one that sounds like it's straight out of a thriller movie: buy, borrow, die. This isn't just some catchy phrase. It's a real, powerful 3-step financial plan that lets the rich fund an amazing lifestyle, all while kicking the tax can down the road, and then, eventually, making it disappear altogether. So, how in the world does this actually work? Well, step 1 is simple. Buy something that goes up in value, like stocks or real estate, and then just hold on to it. The golden rule here is you never, ever sell. Step 2. Instead of selling, you walk into a bank and, using your giant stock portfolio as collateral, you take out a massive loan. And here's the key: a loan isn't income, so it isn't taxed. You can live off this borrowed money for years. Step 3? Well, step 3 is you die. Now, what makes this whole thing possible is some pretty simple math. You see, banks absolutely love lending money to billionaires, and they give them these rock-bottom interest rates, maybe 2 or 3%. I mean, compare that to the 20+% you pay in capital gains tax. As long as their investments are growing faster than the interest on their loan, which historically they have, they're actually getting richer while they're spending borrowed money. It's wild. They can even take out new loans just to pay the interest on the old ones. It's this perpetual cycle of debt-funded living. But wait, you're probably asking, what about all that debt they've racked up? This is where the magic happens. The die part of the strategy triggers this powerful, almost unbelievable feature of the tax code called the stepped-up basis. So when you die and your kids inherit your stock, the IRS basically resets its value for tax purposes. The new cost is whatever the stock was worth on the day you died. All those decades of capital gains, they are legally and permanently erased. Poof, gone. This chart really shows you just how insane this rule is. Let's say you bought stock for $10 million, and when you die, it's worth $1 billion. That's a $990 million taxable gain that should have led to a huge tax bill. But nope. Thanks to the stepped-up basis, your heir inherits that stock with a new cost basis of $1 billion. They can then immediately sell, say, 100 million of it to pay back all those loans you took out. And since the sale price is the same as their new cost basis, the taxable gain is 0. The tax bill just completely evaporates. Okay, so you figured out how to avoid a lifetime of capital gains taxes. That's a huge win. But there's another giant tax monster waiting for you: the estate tax. It's a 40% tax on huge fortunes when they're passed to the next generation. This is where the wealthy build a legal fortress to protect their money, and the number one building block for that fortress is the trust. The easiest way to think about a trust is like a legal lockbox. You take your assets, your cash, your stocks, your houses, and you put them inside it. You name someone to manage the box, a trustee, for the benefit of your kids, the beneficiaries. But here's the absolute crucial part. Once you put those assets into what's called an irrevocable trust, you have legally given up ownership. The lockbox owns them now, not you. And that means, when you die, anything in that lockbox isn't considered part of your estate, so it's totally shielded from the estate tax. And we're not just talking about one kind of trust. Oh no. The ultra-wealthy have an entire bag of tricks, a whole alphabet soup of complex legal structures. You've got things like SLATs, spousal lifetime access trusts, where one spouse can put assets in a trust for the other. The money is legally out of their estate, but the family can still access it. It's a whole world of elite legal engineering designed to navigate the tax code. Now, you might be sitting there thinking, why do I need all this? Right now, the law lets every person pass on about $15 million completely tax-free, so that's $30 million for a married couple. For most families, that's more than enough. But when you're talking about fortunes in the hundreds of millions or billions, that $15 million exemption is just a drop in the bucket. For them, trusts are absolutely essential. And this is where it gets really powerful for creating multi-generational dynasties of wealth. When you put that $15 million of stock into a trust, you're not just shielding that initial amount. No, you're shielding all of its future growth too. So if that stock explodes in value over the next 20 years and becomes worth $100 million, that entire amount, all that growth, passes to your heirs completely outside of the estate and completely tax-free. Alright, let's switch gears a little bit, away from personal wealth and over to business income. Because there's another, much quieter loophole that has allowed some of the richest people in finance to legally opt out of a tax that, well, pretty much every other working American pays on every single paycheck. For you and me, the Medicare tax is just a fact of life, right? It's that 2.9% tax on our earnings that funds health insurance for seniors. If you're a high earner, you even pay an extra bit on top of that. But a massive ProPublica investigation looking at leaked IRS files revealed how some of the biggest hedge fund and private equity billionaires have managed to classify their gigantic earnings in a way that lets them avoid it completely. So how did this even happen? Well, it all goes back to a 1977 law that was meant for passive investors, people called limited partners, letting them off the hook for this tax. But then in the 90s, super active hedge fund managers started calling themselves limited partners to get the tax break. The IRS saw what was happening and tried to close the loophole back in 1997. But a huge lobbying effort brilliantly reframed the fix as a nasty little tax increase, and Congress stepped in and blocked the IRS. And believe it or not, that fight is still going on today in the courts. So who's benefiting from this? Well, according to ProPublica's analysis of those tax records, it's some of the absolute biggest names on Wall Street. People like Steve Cohen, Steven Schwartzman from Blackstone, Bill Ackman, they have all used this limited partner loophole to legally shield hundreds of millions of dollars in earnings from Medicare taxes in certain years. And all of this brings us to the biggest, most important question of all. Why? Why do these loopholes exist and why do they stick around for decades? Well, it's really a mix of three things. How the rules were written in the first place, some incredibly powerful lobbying to keep them that way, and just plain old political fear of rocking the boat. This quote from 1997 from the Speaker of the House at the time, Newt Gingrich, just perfectly captures the politics of it. When the IRS tried to say, hey, active business managers should probably pay this tax, it was immediately spun by lobbyists and politicians, not as closing a loophole, but as a nasty little tax increase. And that kind of messaging has been incredibly effective at shutting down any attempt at reform for decades. And this isn't just some old story from the 90s. A former top economic advisor to President Obama said that when they were looking for ways to pay for the Affordable Care Act, they looked at closing these exact loopholes. But they backed down. Why? He said it was because of 100% political fear of angering the powerful business lobby and putting the entire healthcare bill at risk. Now, it is absolutely essential that we end on this point. Everything we've talked about today falls under the category of tax avoidance. That means using the tax law exactly as it is written to your own advantage. This is completely different from tax evasion, which is the illegal act of not paying taxes you actually owe. All of these strategies are part of a very complex and very legal system of tax planning. Which really just leaves us with one final thought to chew on. The US tax code is this incredibly complicated maze of rules and incentives and exceptions, all built up over more than a century of laws and lobbying. So the big question is, when the ultra-wealthy use all these sophisticated strategies we've talked about, are they just playing the game better than the rest of us? Or has the game itself been designed, whether on purpose or not, to favor the very people who have the resources to master its complexity?